Hi, and welcome back to Pay Down Debt Solutions. I'm Jen, or welcome to Pay Down Debt Solutions, I should say, if you are coming to us brand new and want to learn a different way to run your finances to get yourself out of debt in double the time. So, I want to go over a few things today with you, and I have them written on the board here. But number one, first and foremost, I want to say that you guys, no matter what situation brings you to us, okay, it is never too late to start velocity banking. It is never too late to do something different, just like it's never too late to teach an old dog a new trick, right? It's never too late. So you might be in a debt repayment plan right now. You may have already filed for bankruptcy. You may have had a bankruptcy and put it behind you and have some kind of a line of credit to work with. But it is never too late. It is always a good time to start velocity banking. Now, there are certainly, sometimes are a little more beneficial than others, and that's something that we'll kind of go over today too. But one of the things I want to talk about is fear. Okay, so we're going to talk about fear. We're going to talk about number two, problems with credit utilization. So very many of you out there have some credit utilization problems, and we are seeing in our messages, right, in our comments, that you guys have problems trying to, get extra lines of credit because your credit utilization is high. So let's discuss that today too. Ways around this and what you can do about it. I want to talk about understanding income in and expenses out. Okay, so that is still sometimes tripping people up about income in and expenses out. And that's going to go along with this here, talking about timing, such as Dan talked to you guys about the other day. Okay, timing and how that all plays, because we are not doing our job, okay? If we make it look like this is all sunshine and roses all the time and that it's super easy every step of the way, because there are certain parts of it that are a little bit more complex that you guys have to pay attention to. Does it mean it's a deal breaker? No. Does it mean that you're going to be overwhelmed at times? Yeah, probably. Until you learn something right inside and out, until you really learn something, you will be overwhelmed by it, okay? So your ability to learn, how quickly you learn, and how fast you can implement that is going to change your life. But if you are overwhelmed, the first thing I want you to do is watch, and then watch again. Okay. The more you watch, the more you listen, the more you learn about velocity banking, the more you're going to understand the timing and understand this income in and expenses out. Okay. So you will begin to understand that. That comes more into play too, like Dan explained, when we're talking about credit cards. Okay. So it becomes more important when we're working with credit cards as your debt destroyer. All right. And so then we're going to talk about the difference between using a credit card as your debt destroyer and a PLOC, HELOC, or business line of credit. Okay. It is simple. All right. The difference is simple, but it is very important. Okay. So I will work a strategy for you guys showing the difference between the two and why you would prefer one over the other. But if you can't do a line of credit, how you then can implement with credit cards again using, past knowledge and future knowledge, right? And looking at your situation and knowing how to work within it, okay? So we'll go over that. Now, number one, again, it's never too late to start velocity banking. So some of you out there have entered bankruptcy or filed for bankruptcy and you're looking at this going, well, I can't start velocity banking. It's too late for me. Well, if you have the ability to get a line of credit or a credit card or currently have a line of credit or credit card, doesn't matter if it's maxed, we can work with that and we can show you how to do velocity banking. Okay. So it really is never too late. All right. So then a couple things surrounding, learning something new in general, right? You can apply this to life even. Okay. We all have fear over things, right? So when you think about it and you look at babies, anybody out there that has had children, you know that you never put a baby on a bed, right? Because if they can crawl, the first thing they're going to do is crawl right off the edge of that bed, right? And they're going to do that because they have no fear. They don't have any understanding of, their surroundings and how dangerous it could be, right? So they don't have that fear. So they will go ahead and crawl right off the edge of that bed. Well, you guys have all learned fear. You've learned to be afraid of things. Okay. And so that's why when it comes to change, people get really nervous about change because anything they don't understand, anything they don't, perceive or understand completely, they're afraid of. Well, what is fear? What do you think fear is? I'm going to show you exactly what fear is. Fear is a false emotion around reality. So fear is what you make of it, right? So if fear is a false emotion around reality, how do you change that? How do you do something different if you're afraid? You stop being afraid. You learn. Number one, babies learn not to crawl off the edge, right? They learn this. They learn there are consequences. They learn that things will hurt if they touch it. A hot stove is going to hurt. Your ability to learn and how fast you learn is how quickly you're going to be able to implement your velocity banking strategy with complete understanding and knowledge around it. But you have to take that step. And the first step, of course, is learning and watching videos to understand velocity banking, understanding the key principles, okay? The key principles that we teach and our method is a 3-step strategy. Number one is to organize all your bills. We talk about that all the time. It's organizing, right? So if you don't organize what you have coming into your checking account and going out of your checking account or your line of credit, right? And typically we teach lines of credit instead of checking accounts. But the first thing you have to do when you're working within your system, the traditional banking system, is knowing what you have to work with, okay? And knowing that is power. I know that you guys go through life, you're afraid, right? You're afraid to look at your finances. You don't want to look at them. You don't want to organize them because it's terrifying to you. Well, guess what? When you do that, when you put the blinders on and you don't look at things, all you're doing is making things worse for you. You're increasing that anxiety, right? Again, false emotion around reality, increasing that anxiety. When you don't know what your reality is, there's fear surrounding it. And you think it's going to be worse when you get in and organize your bills and start taking a look at it. And for a moment, it might be. It just might feel really bad for a minute. But you know what, you guys, once you get into that and you start looking at it and you understand your picture, that is when you can formulate a plan and that is when you can change things. See, Dan and I are not doing our job if we don't do things like Dan did in his video the other day, where he talked to you guys about the intricacies of learning how to run your finances through a checking account, through a credit card and holding money back into that checking account to pay for those bills that are coming up, right? So we know that most of the time we talk about your monthly bills, right? We take a snapshot of your month, but that does break down into, 2 weeks at a time for paychecks, some paychecks, or weekly for other paychecks. But aside from all of that, whether you're paid monthly, weekly, bi-weekly, it doesn't matter. You have to know what's coming, okay? You always have to know what's coming. You have to know what you've just paid and what you're going to be paying. And that is the trick. That is the timing trick to velocity banking. Dan is a highly organized, gets into the weeds kind of person. And I do have to say, he did say something wrong that I'm going to point out. Love you, babe. But what he did say was that our workshop is July 19th. It is not. It is July 20th. That is on a Sunday. So I do have to correct him there. Anyway, so my detail-oriented husband out there who does get into the weeds for you and is trying to show you guys exactly what this is going to look like, okay? So when you're inside of velocity banking and you're looking at your checking account, knowing that you have to hold some of those finances out, right? Because you're going to have to pay non-chargeables. Remember, when we have when we're working with credit cards, it breaks down into what we call chargeables. Here, let me get rid of organize because we know we have to organize our debts, right? We have chargeables, right? Chargeable expenses. Okay, so we have chargeables and we have our non-chargeables. Okay. Now, we'll put an S on that. Now, what Dan is saying is that, yes, we break things down and we know we're going to put all of our available income onto our debt destroyer, that credit card. All of your available income is going to go on that. And all of your non-chargeables, right? Your non-chargeable expenses that you can't run through your credit card have to be held into your checking. So what are those non-chargeables? Well, let's think about it. What about our mortgage? Our mortgage, you really can't charge on a credit card. Yes, you can. There are ways to do it, but it costs you money. So you're better off just leaving it in the checking account. Okay. So your mortgage, you can't charge. Your other credit cards, you really can't charge. You can't charge loans. Okay. The only things that are chargeable to you, right, are for the most part your utilities, your gas, your groceries, all of your fun money, the fun things you're going to do, right? Most everything in life that you're going to, live with, your living expenses are all chargeable expenses. Okay. And many utilities out there are chargeable, okay? Phone bills, things like that, those are chargeable expenses. So when you have those chargeable expenses, you have to know when you need to pay them, okay? So if you're not paid every week, which makes it sometimes a little bit easier when dealing with this, right? So if you're not paid every week and you are paid monthly or bi-weekly, then you have to look at the first of the month. Okay, so here's the first of the month. Here's the end of the month. Okay, we'll just say 30th for whatever. Okay, so the first and the end. And you have to know what bills, okay, are in between. So you have to know what bills are in between. And you also have to know, okay, so I get paid here and I get paid here. Okay, so you have to hold out enough money to get you to that next paycheck in order to pay for the bills that you have coming, okay? And that is where budgeting and our very simple budget sheet can come in handy too, because we break it down weekly when you look at your budget with our budget sheets. When you break it down weekly and say to yourself, okay, this week I have X amount of bills that are due, so I have to make sure I have a way to pay those. Either I'm putting enough into that debt destroyer for them, or I'm holding enough back into that checking account to pay them. And then it's a few days until my next paycheck, right? So I have to make sure I have enough to pay for bills that are coming due before that paycheck so that I can accomplish those bills, right? Take care of those bills before I'm paid again. So it is about timing. And that's where Dan really wanted to get into the weeds for you and get into timing, because timing matters, right? Where you're paid in this month matters. Now, the other thing we talk about when we're dealing with credit cards is the fact that many of you come to us with maxed credit cards. Okay, so you're maxed. And so if you're maxed, you have to have a way of handling that without the credit card companies lowering your limits. Okay, and in order to do that, and I'm going to bring this out again. Okay, in order to do that, whoa, I'm losing it, guys. All right, in order to do that, we go through our maxed card strategy, right? So we know that this is our micro pay, all right? So when you have a maxed card strategy and you're going to micro pay, you have to do it this way, where you have, let's say you have $1,200 that you need to put on a specific card, okay? So that's what your bills are coming out of it, all of that, right? So you know you have about $1,200 you need to put on that card, and you're going to be spending your expenses, your living expenses out of it. So you have to divide that up by about 15 payments, right? So about every other day for that month, you want to start putting in your money from your checking account onto that card, okay? And this way, it keeps your bank from lowering the limits on you, okay? So when you put money in and then you're spending money out of it and putting money back in and spending back out of it, you're revolving it more, right? Revolving debt. So you're revolving that more. Then what happens is it doesn't trip the algorithm that will catch big deposits, okay? And a lot of times those big deposits are what catch you and cause the bank to lower your limit. All right. So if you're going to try velocity banking, and of course we encourage you to do this because this is the way to take care of things. We are not going to drop you on it. We are going to help you guys every step of the way. We will answer your questions. So if this feels overwhelming to you, take a deep breath. Don't have fear, okay? That is just false emotion around reality. Don't have fear. We will help you with this. You're going to learn how to handle it. And remember, it's all just timing things, right? It's a dance, it's a balance, and that's what you have to learn with velocity banking, especially when it comes to credit cards. Now, it is easier to do it through personal lines of credit and home equity lines of credit, business lines of credit. Those are easier because it's less of a dance, right? You have money coming in monthly, you're expending, your expenses are coming out, and you're going to be running that way, and you don't have to worry so much about the things you do when you have credit cards and you're maxed and you're also working with a micropay strategy, which actually does help you because that way you're constantly putting money in. So you should have money constantly going in to help pay those bills, but you still have to know when they come due. Okay. So this leads me very beautifully into problems with credit utilization. Okay. So now, many of you out there can't get lines of credit or other debt tools, okay, because your credit utilization is high. So what does that mean? So that means your credit limits are your balances, I should say, are close to the credit limit, okay, on the majority of your cards. If your balances are close to the limit, then you have what we call high utilization, okay? You guys, it doesn't matter whether you're a doctor or a dog trainer, okay? So what I mean by that is it doesn't matter if you're lower income or higher income. And maybe there are dog trainers out there that make a ton of money. I don't know. So sorry, I'm not trying to be offensive. All right. But anyway, so no matter what your income spread is, right? It doesn't matter. We're all feeling the pinch. We're all feeling in the same position because we are in the same position, right? Just because you have lower income, that just means your bills are lower. However, your credit utilization can be high. Same thing on the scale with people that are making a lot of money. Chances are their debts are a lot bigger, right? And so their credit utilization as well could be very high. So we are all in that same boat, no matter what our job is, okay? No matter how we define ourselves, we still could have problems with credit utilization, and many do. So here's how to look at that. Your credit utilization, okay, you want to be about 30% or less, okay? So truly, that's what they're looking at as good utilization. Now, in reality, people use a lot more. We use like 75% utilization a lot of times, okay? That's where we fall, and we have no problem getting 0% cards, credit cards, loans, lines, whatever. We don't have a problem with that. But our utilization is considered high, okay? Now, there's ways that you can work with that, okay? And there are things that you can do to help lower it or make it look better than it might actually be, all right? So one of the things you can do, number one, is, okay, you could go apply for credit cards and get more credit cards that you don't put balances on. And of course, that's going to lower your utilization because you have cards that are available with no balance on them, okay? So if you have that situation and you're able to do that, by all means, get more cards, because you know me, I like those credit cards and I like you guys to have it because they're emergency money. It's a place to go. Now, if you have utilization problems, a lot of times you can't do that. So it's not so simple, Jen, right? Like, duh. All right, so what else can you do? All right, so when you have problems with credit utilization, credit's high, you might not be able to get another card or a new card, but here's something you could do. If you're paying your bills on time, trust me, your credit card companies love you because they're feeding off of you. They're earning interest on you. So many times you can call and get your limits raised, okay? So that might seem like an impossibility, but believe it or not, many people who feel that they can't get any more credit, okay, maybe they can't get a new card, but they can call the card that they currently have, or you can actually do it online too. So you can do it online and go and raise your limits, or you can request for your limits to be raised. Now, if you go in person, you might be able to negotiate a little bit. I'm sorry, if you call in person, you might be able to negotiate a little bit or get a hint from them as to how much you're going to be able to get. If you do it online, sometimes you just have to submit it and it comes back at, whatever it's going to come back at. Now, if you're concerned about that credit hit, you can call and ask whether they do a soft or a hard pull, okay? Most of the time now it is a soft pull. All right, so if it's a soft pull, it's really not going to impact you. So guess what, you guys? Try. Why wouldn't you? If you are already in a position where you need to do something else, okay? And if it's going to be a soft pull, put in for it, see if you can get yourself a little bit higher limit, okay? That would be amazing if you can. And then you still can run your micro pay strategy a little bit, right? And see it to make sure things are going to go okay. But chances are you might not have to be worrying so much about making that micro pay strategy happen if they raise your limit for you. Now, that's the reason we care about utilization, right? Is the fact that we want to get more credit to be able to work more of our debt down. So that is helpful to us by being able to move balances, okay? So that is something that you can also try. Another trick is this. So if you want your credit utilization report to be lower, what happens is credit card companies will submit to the bureaus, okay, what your utilization is towards the end of your statement cycle, okay? So your statement period, that's when they do the reporting. You can see it'll match up on your credit report, okay? The time that they report it versus, when that statement cuts. So if you can then, have a deposit go in right before the end of the statement cycle, that would probably help your utilization. So if you can do a bigger deposit by then, if you have the ability to, then you can try that and it'll help your utilization score. Now, of course, we teach that you don't want to do that. You want to do it in the reverse, right? Because you want to hold your balances as low as possible for as long as possible until the next statement period, and then charge it up and then do it again for the next month, right? Well, if you're trying to play the utilization game, you might have to stave off on that a little bit and play it this way just to see if it can report for you the right way. Okay, so there's a couple different things you can try. Now, absolutely, though, you guys call and try to get your limits raised, or go online and try to get your credit limit raised that way, especially if it's a soft pull. You might just be surprised. Okay. You might be surprised. Even if you've gone in and been turned down by one institution, the same institution that has your card currently might actually give you more because you have history with them, especially if you're able to pay. Okay. So that's something to consider. Okay. So then I want to get into for you guys understanding income in and expenses out. Okay, so running income in, expenses out. And it goes hand in hand again with the checking and your credit cards. Okay, so when we say income in, you are taking all of the available income that you have to work with. Okay, so you're going to be looking at your non chargeables. Okay, holding out your non chargeables from your income. Okay, because you have to pay that out of your checking account. And the rest of the money then goes into that checking account. The rest goes into the checking account. So you're holding back whatever you have to hold back to pay those non chargeable bills with. And again, looking at your timing, time it and know if I'm holding back X amount because I've paid these bills, all right, I know my next checking account deposit is going to be whenever that date is. Okay, so I have to hold out this amount and I can pay the rest onto my credit card to cover my chargeables. Okay. So again, Dan's video that he did yesterday really gets into the weeds on that, gets into the nitty gritty, goes and explains it thoroughly. I'm trying to do a superficial overview for you. For those of you that, oh my God, it's so overwhelming. So for those of you that got overwhelmed by it, I want you to understand, take a deep breath, because Dan said at the end, you're going to be living this and you're going to be able to do it from your couch on your phone. It isn't as scary as it sounds when you get into it and understand what we mean. We're just saying that you have to know what bills you have due and what bills you have coming so that the timing of things works out very well. Otherwise, you can get caught without having the ability to pay a bill because maybe you've put too much into your debt destroyer at a time you should not have. Okay. So you just have to time it a little bit better. Okay, so again, income in. So your available income that you have available to you, especially working with credit cards, right? And this is when it matters. That available income goes into your credit card. Everything else that you cannot pay through that credit card, you have to hold back into your checking and you have to pay it through auto debit or, call and pay a bill through the debit card, whatever you need to do to make those payments. Okay. Now, when you're dealing with a line, okay, a personal line of credit, a home equity line of credit, or a business line of credit, all of your income can go into that line of credit. Every penny of it goes into that line of credit. Okay. It goes in because you can then move the money back to your checking to pay your bills. All right. Now, it sounds very counterintuitive, and I understand that. But the reason is, remember, when we're looking at the average daily balance, when you put in that big chunk of income, drops your average daily balance, which then drops the interest charges for you. So you play a little bit of a game. You let it go in, all of your money go into your debt destroyer, which is your line of credit, your PLOC, HELOC, or BLOC. Okay, you let it go in, and then as needed, you pull it out to pay your bills. Or some of them are set up like overdraft protection, where it just pulls right out of that line of credit for you and pays your bills, which is phenomenal, so long as you are not charged. Okay, so I hope I've cleared some of this up for you. I hope I've taken some of this fear, this false emotion around reality. I hope I've taken that out of you. I hope that you sit there and you take a deep breath and you say, I have nothing to be afraid of. I have learned things that make me afraid, but I can unlearn the things that make me afraid. Okay. And you can unlearn those because you know that when you know more about a subject, when you understand the in-depth detail of it, you will feel better because you understand it. Just like when you're organizing your bills, I erased it. When you organize your bills, you will feel better. Momentarily, you will feel more anxiety ridden. But once you understand it, you're going to feel better. You will. You will feel so much better, you guys. Okay. And then I'm going to get in for you. I'm going to erase the board and I'm going to show you the difference between using a PLOC and a credit card and kind of explain that once again for you to clear up any confusion. Okay, you guys ready to get into income in and expenses out and why your PLOCs and your HELOCs work a little bit better than the credit cards, right? So we know you're going to win with velocity banking no matter what, okay? You're just going to win. But there is a better way to put your income in, because you can use all of your income when you're using lines of credit such as a PLOC, a HELOC, or a BLOC, okay? And so the reason is, again, you can use all of your income. And when you put all of your income in, it's that big drop, right? It's that big drop that helps you out. Now, when you're using credit cards, those non-chargeable expenses have to be held out, and we know this. And so when you're holding out those non-chargeable expenses, if you have quite a few non-chargeable expenses, you're not going to benefit quite as much as you do when you use the personal lines of credit or the home equity lines of credit, okay? So let's get into this is a hypothetical here for you. I am using real numbers though. So these numbers are real. They're pulled from other student scenarios, and I'm pulling these numbers together to kind of show you how this would all work out and work together hand in hand, all right? So again, remember, no more fear, no more false emotion around reality, because we are going to change that for you. It is going to benefit you to rethink some things, right? You need a mindset change. This is different, right? It is very different when you're using lines of credit instead of your checking account to work your debt down. It is different, and it is scary sometimes because of course change is scary, but when you do it the right way, you guys, this will save you so much money at the end of the day. It really will. And it saves you time, and we all know time is money, okay? All right. So we have a scenario here that I put together, a hypothetical for you, where we're doing income. Again, I'm using real numbers. The income is $4,800. Our total expenses here are $4,765, which leaves us with a cash flow of $35. And I should write that down. So we've got cash flow here of $35. All right. Now, this is really real, okay? So this is really incredibly real. We are seeing lots of this kind of stuff, right? Where cash flow is nil. It's not a whole lot. And we're seeing lots of negative cash flows too. But there's hope for you. Believe me, we do this every day, you guys. We do it every single day. We're helping people every day fix their negatives, turn them into a positive, and work down debt faster, okay? All right. So cash flow here is $35. We're going to say that they have rent/mortgage. Either one doesn't make a difference. Of $1,260 and car payment of $411, all right? And we're putting these up here because we're not going to put them into the equation, although I guess I could have maybe if I'm running this HELOC, although there's not enough room. So anyway, so we've got Chase here. We're using a Chase card and a Bank of America card in this situation. For the Chase card is $20,000, $456. So the payment on that is $597. It is at a 23% interest rate for 4.9 years to traditionally bank this and term this out. It'll cost them $13,189, okay? Now, again, both of these payments are interest plus 1%, all right? Interest plus 1%. And so that's why we're at 4.9 and 4.8. I have shown examples for you guys of credit cards taking repayment terms of 23 years, 16 years, 15 years, all sorts of different time frames. But most of the cards right now are trying to squeeze you for that interest plus 1%, which at the end of the day is better for you, right? Honestly, it is. Okay, Bank of America is at $4,350. The payment on that is $130. The interest rate is 24%. We are at a 4.8 years payment to term this out, and it's at $2,890, which means our total debt in this scenario, this hypothetical, is $24,806. Our payments and just debt payments are $727. This is what we're looking to get back, okay? And then our total amount that we're repaying here in interest is going to be $16,079, okay? So that is our total interest. Now, remember how I talked about my example the other day about what you need, the jugs of water, right? If I'm a runner, and I have 1 jug of water that I need a month, let's say, but yet my intake is 4 jugs of water. I no longer need this jug because I have 4 more over here, right, that I'm taking in. So this one becomes irrelevant. And that's why this payment, right, this jug of water comes back to me, and it comes back as cash flow to replenish me or to work down your card, okay? So that's how I want you to think about getting these numbers back to you. When we say the income is satisfied, my dehydration is satisfied, the payment is satisfied because we're putting more income in. That is the idea behind putting your income into your debt destroyer, be it a line of credit such as a personal or a credit card, right, or a home equity or whatever. You're putting your income in, you're running your expenses out, and that payment amount comes back to me then, and works down my debt or my dehydration. Okay. All right. So let's first work with the PLOC, the HELOC, the BLOC. Okay. So let's say I have, in this case, we'll call it a HELOC. And we're going to say it's at 14%, which would be pretty darn high right now for a HELOC. But let's say it's at 14%. Okay. And let's say our line is for $37,000. Okay. We know that our total debts here are $24,806. Because if you add these two numbers here, and I'm off screen, if you add these together, we're at $24,806, all right? So that is what we're starting with. And we start with our entire income amount, okay? We can put our entire income amount into this line of credit. We can do that because, remember, your income goes into that checking account. Your checking account, then you make a payment to your line of credit for the entire amount of your paycheck. It sits in that line of credit, and it sits there until your expenses start to come out of your account, right? Now, some of you have a little card that is attached to that line, and you can actually use that card to make payments. So you can set payments up directly off of that line of credit card, and it comes right off of your line of credit. Very cool. That is a very cool thing you can do. Some of you don't have that, and your debits are coming out of your payments, right, are coming out of that checking account. And so the money then moves from that home equity line of credit or personal line of credit into the checking account. The checking account then distributes the money to pay your bills, okay? Same thing, if you swipe that debit card and it pulls from the line of credit, you're just paying your bills that way, or you're gonna use that card, the little card that's attached to your line of credit, and you're gonna swipe it just like you would a credit card or a debit card. So no matter how you work it, so all banks are different, they have different ways to do it. I know one of these big banks over here has all of those ways, okay? And so that's what Dan and I have. We have the one that has all of those ways. And so you just have to figure out how you want to run that. But easy, you guys, very easy. Goes into your checking account, think of it this way. Goes into my checking account, I can use my debit card, boom, done, right? The money's gonna move. If it doesn't transfer automatically for you, you just manually move it. But guess what? There's this thing called a phone and a button, and then you swipe and you type numbers in, and you can make that happen like that, right? So it's pretty simple. Okay, so anyway, so my entire income is going to go in. It drops my balance immediately to $20,006. Then my expenses have to come out, right? Because I'm paying for things. I'm paying for everything. My rent is coming out. My car is coming out. My utilities, my fund money, my groceries, my gas, all of it is coming out of this account, okay? And so it's going to work back up to $4,038, which is my expenses, right? And these expenses, again, are going to be minus the Chase amount and minus the BOA, because those are my jugs of water that I don't need anymore, right? They come back to me. So these payments are coming back to me, all right? And so that's why they're subtracted off of our total expenses here. All right, so then it drops us to, it brings us back up to $24,305. Now, this is where you guys have to do your checks. How are you doing for the month? Are you doing okay? Are you continuing to work your debt down, or are you going in the opposite direction, okay? Well, 24,305, is it greater or less than what I started out with? And I would say it's less than, so we know we're working our debt down. So that's going to work, okay? Now, I will reveal this in the end to see what the difference is and to see how long this took. So now we are going to then flip over and we are going to go with our credit cards. So here we have a situation where we have available income, chargeable expenses, and non-chargeables, okay? So we have to look at things that way when we're working with credit cards, because we know we have to hold out our income and our expenses that we cannot charge through a credit card, okay? Which means that I have to hold out the income and leave it in my checking account so I can pay my bills. And remember, this is where your timing comes in. You're looking ahead to see what your future bills are. You're looking to see what bills are due right now, and you're timing it so that you have money to pay those with in the future. So like Dan said, you can't always just slap down all of your money that you get when you get your paycheck onto that card and just hold out, the total amounts, right? You have to kind of play with it a little, because there are different times during the month that those expenses are going to come out. So you're going to have to look at that and just prepare for it. Go watch his video again. I'm not going to say it enough, right? I can't say it enough, I should say, because it's really important that you understand that concept. It is very important, especially when dealing with credit cards, which a lot of you are doing. I don't want you to be afraid of it. Don't fear this, right? You're learning, okay? You are a learned person now about this specific thing here that we just have to make sure we're taking care of, okay? False emotion around reality. Don't fear it. Okay, so we have our available income, which is our, right over here, our available income is $4,800. So you're going to take your $4,800, you're going to subtract the $1,260, you're going to subtract the $411, and you're going to subtract the $130. Because we are starting in step one here, okay, so this is our first step. We're starting with that credit card, the $20,456. So that payment is coming back to me and helping work down the card. So that's why I'm holding it out of my income there, okay, so it's no longer there. Now, or I'm saying I don't have to hold it out, it is inside my income. All right, now my chargeable expenses are, again, we're taking our chargeable expenses, the $4,765, the $4,765 minus the $1,260, which is our mortgage, minus our car payment, minus the payment for my Chase card, minus the payment for my Bank of America card, because they're all chargeable expenses. Now, sometimes you see Dan will do it where he'll subtract them from the chargeable expenses and leave it out of the income. I do it in the reverse. As long as it's coming out of one or the other, it doesn't make a big difference in the end. It's like minor, like dollars maybe, okay? So you just conceptually, however it's easiest for you to think about, the number should still work out in the end, okay? So now we know that my chargeable expenses that I'm starting off with are $2,367. So I'm never gonna change this variable if I'm changing this variable. Conversely, I'm never gonna change this variable if I'm changing this variable. All right, so $20,456 minus off the $2,999, right? Because that's what I'm with my available income to start off with. And so we then, it drops our balance to $17,657, which is lower than this, obviously. And then our expenses have to come out. Now my expenses, again, are the $2,367, right? And then I have to add my interest, okay? Now, if you're brand new to us and you don't know how to calculate the interest, you don't know where in the world I'm getting this number from, I'm going to show you. Okay, so we have our high balance and our low balance, right? Now we have to take an average because we know that when we put our income into this, it's going to drop our balance and our interest rate is going to drop because our lines of credit are figured on an average daily balance, and that average daily balance is what helps us defeat, right? That's what helps velocity banking work well to defeat interest is a better way to put that. Okay, so we have to take an average though, because we're not gonna stay at the 20,000. It's going to drop to 17, but it is gonna come back up as my expenses come back out of that, or come back into that card, right? So what I do is I have to take an average. So I'm going to take my 20,000, so my 20,456, and I'm going to add my 17,657, okay, which equals 38,113. But then I have to divide it by 2, okay, so dividing it by 2, which equals 19,056, all right. Now, my 19,056 has to then be multiplied by the card percentage, which is 23%. So I'm going to multiply that by 0.23 because I moved my decimal, and it equals 4382.9. And then I'm going to take that and I'm going to divide it by 12, okay, which gives me 365, which gives me, 363 here. I must have fudged a number somewhere, guys, sorry. Anyway, so it's going to give me about let's see if I did this right. 20,456 plus, here, let me show you an example, then have it not work out well for you. All right, so 38,113. Okay, so then we're going to divide it by 2, and then we're going to then multiply that by 0.23, and then I'm going to divide that by 12. Yeah, it's 365. Okay, so I goofed. So 363 should be 365. My apologies. I'm sorry. All right. So now you all know I'm less than perfect. So anyway, so this should be 365. Okay, but we're going to take this number because that's what I figured this on. So 20,187 is what it ends up being after I take my expenses, have to come back into the card, and I have to add my interest back in. Okay, so remember, you got to take that average, and then you're going to divide it by, you're going to get your average. So you multiply, or I'm sorry, you add the 20, you add the 17, you then divide that number by 2, right? Then you're going to multiply by the 0.23, and I'll bet you I multiplied it by the 0.24 when I did that. So you're going to multiply by that, then you're going to divide that number by 12 because you only need 1 month, because every month this number here is going to go down every single month if we're running our card correctly, okay? So this step here takes me 15 months, and at the 15-month mark, something's going to happen. I'm going to be looking at my balances, and I'm going to be looking at my Bank of America balance at the same time, and I'm going to say, okay, can I put one into the other? Can I tip this cup into the jug, right? Can I do that? Well, at 15 months, I can, okay, because my balance is now, my Chase balance is down to $15,831. And at this point, this is the interest I've spent, okay, $4,855. But this is what I'm concerned with here, is the $15,831, because in my step 2 here, okay, so this is step 2. In step 2, my Bank of America balance has now run down to $3,606, right? Because while I'm working my debts down with my Chase card, my Bank of America card I'm still making payments on, and it is lowering, correct? It is. So at 15 months, it's down to $3,606. Now, to do a balance transfer, all right, so you're going to call your card company and you're going to say, I'd like to transfer a balance. They'll either do it for you or they're going to send you a convenience check, because you're going to ask them very nicely to do that. And there usually is going to be a percentage that they will charge you, like a 4% fee, okay? Now, your 4% fee is going to then be added in. So it's going to be 0.24 times your 3606, and it's going to give you 144. So as you can see, I've added my 15,831. I've added my 3606, okay, my 3606, because that's where Bank of America balance is at. And I'm going to add in my interest, my 144. So that means I am starting out now with both cards together combined, $19,581. Okay, very cool, right? So now something else happens. I no longer have my $130 that I have to hold out of my income, okay? So I'm gonna add that back in, so $3,129. So it drops my balance then to $16,452. So my expenses are going to come out, right? My expenses come out, and my interest is going to then be calculated, and my interest is, well, it goes back in. I hate that I say that. It doesn't go out, it actually comes back in, right? So my interest is gonna come back in, my expenses are gonna come back in, which brings me back up to $19,164, all right? Now, we do our checks. Is $19,164 greater or less than where we started from at the $19,581? Well, it's less than, so we are going in the right direction. So to end this card, okay, to end this out, we know that if this step 2, takes us 30 months, okay, we have spent $6,154 combining them together. We have also spent $1,207 as Bank of America ran by itself, okay, it ran its own race by itself, and it spent $1,207 in interest. But it also, we had Chase running, right? So we had Chase running for this 15 months that spent $4,855 in interest. So what does this look like? And let's look at our comparison. Now remember, we don't have all of our income available to use. Some of it is being held out, all right? And yes, we're holding out those chargeable expenses as well, correct? But it doesn't give us the biggest amount to drop our interest when we're holding out those expenses, okay, or that income. So here's what happens, all right? So we're gonna look at our credit card first. So we look at our credit card, and we have spent now, okay, to get this taken care of, all right, to eliminate this debt, it has taken us 3.7 years. Did we save time? Here, it's gonna take almost 5 years, correct? Almost 5 years, so over 4 years, and we have spent a total of $16,079. So we have saved time, yes. Have we saved money? We have also saved money. We have saved ourselves about $3,700 approximately, okay? So you've saved a big chunk of money, you've saved a chunk of time, and you've saved your sanity, and you are no longer afraid because you know how to run Velocity Banking. So if there's any other debts that you have out there, you're going to be running them the same way, because chances are there's a lot more debt going on with you guys than just this. And how do I know? Because we did it and we had lots of debt too. So we did this as well. Now, if we take a look at how these home equity lines, personal lines, and business lines work, right? Remember, we're putting all of our income in, we're running all of our expenses out. So what is the difference? And it is significant, okay? This is the reason why we love these lines of credit. So a couple different reasons here. Number one is they have lower interest rates, right? So the interest rates are lower on them. Even at 14%, when you guys are freaking out thinking 14% is huge, when you'd rather have a loan because that loan officer or that banker is telling you when you walk into the bank, you don't want a line of credit, you want a loan because the interest rate is so much less. Sure you do, right? You don't. You want that higher interest rate all day long. But if you can get it for less higher than the high of a credit card, right? Then even better for you because we know how to work things down properly. So what does this look like? It's taken us 33 months, right? And we have spent $5,119 in interest as opposed to the $12,216 versus, running it just the credit card. But both of these scenarios, right? The credit card only method or the personal line of credit method still saves over traditional banking by at minimum $3,700, right? So we're teaching this all day long, you guys. We're never going to drop you. We're never going to just tell you to figure it out. We're going to help you every step of the way. Continue to watch the videos. We hope that you do. We hope you learn a different way to bank. And if you need anything or have any questions, absolutely let us know. I will see you in the next video.